Let's start our review of Chapter 1. Now in Chapter 1, the main takeaway was the calculation of net income for tax purposes. Now the calculation of net income for tax purposes is different from how we calculate net income for accounting purposes. And there's a specific order that we have to follow. We start off with 3A. 3A includes positive amounts of employment, business, and property income. Now remember, only positive amounts are included in 3A. Examples of property income might be rental income, perhaps interest income. After we calculate 3A, we go to 3B. And this is where we look at the excess of our taxable capital gains over our allowable capital losses. Now these gains and losses would be on the sale of what we refer to as capital items. Capital items are things that the company owns that are used in the business to produce income. So if a company sold machine, building, maybe shares in another company, those would all be reported in this section here. Now the wording is important. Taxable capital gains refers to the 50% amount. Allowable capital losses also refers to the 50% amount. And in 3B, we're only looking for the excess of the taxable capital gains over the allowable capital losses. So what that means is if we have more losses than we do gains, there would be no negative amount we would include. We would only include 0 here if our losses exceeded our gains. And so that would be the 3B amount. Moving on, we then subtract our 3C amounts. Now these 3C deductions would be things such as if the taxpayer paid spousal support, if the taxpayer had eligible moving expenses, child care costs, or if the taxpayer made registered retirement saving plan contributions. The final part in the calculation of net income for tax purposes is 3D. Now 3D would only include current year losses from employment, business, and property. And the main thing to remember is that when we calculate net income for tax purposes, we can never have a negative amount. The total must always be positive or nil. So what does that mean? That means that if we have, let's say in 3B here, any losses that exceed our gains, we cannot record those excess amounts of losses over our gains. And the same thing for 3D. If we have current year losses that would put us in a negative net income position, we cannot use that amount. And so those amounts would get carried over, which will be what we talk about in the next slide. So when we calculate net income for tax purposes, if we are in 3B and we have any allowable capital losses that we could not use up in the current year, they become what we refer to as a net capital loss carryover. The net capital loss carryover can be used in other years, but only to reduce taxable capital gains. And we can use this loss carryover in any of the 3 preceding years, or we can carry it forward unlimited years. Now what about 3D? What do we have some losses from business, property, or employment that we cannot use up in the current year? Well, then those amounts become a non-capital loss carryover. Now with non-capital loss carryovers, we can use it to reduce any type of income in certain years. We can carry those losses back 3 years or carry them forward 20 years. If we cannot use up those losses in 20 years, then they will simply expire. What we will also see in a later chapter is that net income for tax purposes is what we calculate using 3A, 3B, 3C, and 3D, but what we calculate our tax liability on is a concept called taxable income. To get from net income for tax purposes to taxable income, there's some deductions that one could make. And if we were carrying forward losses to another year, in that future year, we would deduct those loss carryovers when we calculate taxable income, not when we calculate net income for tax purposes. Let's then move on to the next slide. In Chapter 1, there was also a number of smaller topics. A lot of terminology was covered in Chapter 1. We also talked about different tax bases here in Canada. There's different ways that the government can levy tax: income tax, property tax, value-added tax. Those would be things such as GST and HST. Now, income tax is the largest revenue source for the government. We also talked about the difference between progressive tax rates and regressive tax. Now, progressive tax basically means that the more you earn, the higher taxes you pay. Now, our federal income tax rates are progressive rates, and provinces also have progressive tax rates as well on personal income tax. A regressive tax is one where somebody who has lower income will pay a higher effective tax rate. That would be, for example, GST and HST. We also talked about the terminology of tax incidence. Who really pays for the taxes? For example, if we have a corporation, the corporation is ultimately legally liable to pay the corporate tax. But there's an argument that maybe indirectly, other parties could be paying for that corporate income tax. For example, shareholders may indirectly be paying through lower dividends. Employees may be paying through lower wages, or the customer may be paying through higher prices. Tax expenditure refers to the amount of tax revenue that is lost by certain tax policies. We talked about the fact that with tax-free savings accounts, individuals that invest in tax-free savings account do not have to pay tax on the income generated through those investments, and so the government loses tax revenue. That means that refers to tax expenditures. There was also a number of qualitative characteristics that we looked at that are desirable for any tax system, and we looked at a number of these characteristics and how they compare to our Canadian tax system. So that sort of is a wrap-up of the main topics that we covered in Chapter 1. Now remember, you as a student should read the entire textbook chapter and do the corresponding exercises and self-study problems for extra practice. That brings us to the end of the Chapter 1 review.